Now I'm going to talk about HSAs, which I think are like the tax hackiest accounts out there. Like there's so much to talk about with HSAs and people just like totally have no idea about it. So if this is something that interests you, watch all the way to the end because there's a lot to say. By the way, this is part 2 of my response to this question. Part 1 refers to traditional 401ks and Roth IRAs and some of the ways you can like tax hack those 2 accounts. So HSAs are health savings accounts. They are available to folks who have high deductible health insurance plans, but not every employer offers the HSA, so you just need to find out if you have access to it. In a lot of cases, your employer will contribute a healthy amount of money to this account to like kind of defray the cost of your deductible. So very often it's a way to actually get more money out of your employer. So it's really great to take advantage of it in that regard. But beyond that, let's get into the nitty-gritties of the HSA. So number 1, it is completely tax-free money if you use it for qualified medical expenses. So the government decides what's qualified, so it's not really up to you to decide what's a qualified medical expense, but it can be used completely tax-free. Here's where things get really interesting. If you can cash flow your medical expenses instead of dipping into your HSA, you can invest the money that is inside of your HSA. And here's why that's important. HSAs are your money. They stay with you for life, unlike an FSA, which is more of like a use it or lose it account. So what you could hypothetically do is get the money that your employer contributes plus max it out, like top it off yourself. I think that this year the max is like $3,600, and then take that money and invest it. Inside of that account, it is going to grow completely capital gains tax-free. Now, if you needed to use it for a medical emergency, you could, but the real way to like utilize this account to its fullest is to not use it for medical expenses. And here's what you can do. Once you reach the age of 65, you can use this money for whatever you want. You will just have to pay ordinary income taxes at the time of withdrawal. It's effectively either completely tax-free money that you can use towards qualified medical expenses, which most things that you would think would be a qualified medical expense are qualified medical expenses. Things like, you know, doctor's appointments and co-pays and things like that are usually qualified medical expenses. Or if you want to be super advantageous with the money, you can invest it and let it grow for years and years and years. And remember, many times it's your employer's money that's growing on your behalf. And when you change jobs and whatnot, it's still your account. You still get to keep it. If you have questions about that, drop it in the comments. Follow for more.